Welcome to Sprott Media. I'm Albert Liu, joined right now by Danielle DiMartino Booth. She's the CEO of Quill Intelligence, a research and analytics firm, and the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. She joins us once again from Dallas, Texas. Danielle, thanks for joining me here at Sprott Media. How are you?
I'm great, thank you. How are you today?
I'm very good. Very excited that you're going to be joining us in Vancouver this year for the very first time. That's conference July 30th to August 2nd. And the great thing about that is it lines up right after the July Fed meeting, so we're going to talk about that. The last time I talked to you, which was the first time, was about 2.5 years ago. You were just coming off, 9 years at the Federal Reserve? You'd written this great book, Fed Up. Are you still fed up?
I was not fed up. My fed upness was on hold for almost a year until the Powell pivot. It seemed like we finally had somebody who was rational, who really didn't care to placate investors, stock market investors. And then there was the moment, January the 4th, he's up on stage with Janet Yellen and Ben Bernanke, and he folded like a deck of cards, and that's it. I went back to being, I'm fed up all over again.
Okay, so let's talk about where we are and the I guess the precise reasons for the problem. We had they've been trying to obviously get out of this position. The position meaning a position of stimulus, a position of quantitative easing. It started back in 2017. We had 4 rate hikes. Are you surprised that it seems like it's coming to an end this year?
No, in fact, I think that the tightening cycle, the ending of the tightening cycle is not the surprise element, if you will. It is how long it took Janet Yellen to begin the normalization process that became so problematic for Jay Powell. He shouldn't have had to step into a position of having to try and hurry up and tighten in order to put enough ammunition in the Fed's chamber to be able to fight the next recession. Most people don't appreciate history, and that is that the Fed has typically had 5.5 percentage points of Fed funds rate decreases in prior easing cycles to combat recessionary times. They don't even have half of that right now. They've got all of 9 quarter-point rate cuts, and the anticipation is that they're going to use 2 of those bullets in their chamber on July the 31st.
So, and you're right. However, they had a pretty big hole to dig themselves out of. So QE was never necessary before either. So they needed that. They needed to go to zero. They needed to hold it. I presume they felt they needed to hold it at zero for that long. So that was not a normal, I guess, a normal response to a recession. Coming next time, what do you see? Even if we did have, say, several cuts in the chamber, would it be enough? Are we still hung over basically from the financial crisis?
Well, it's interesting when you see big headline announcements like Caesars Entertainment being taken out, for example. This is a company that by all virtues was kept in business by quantitative easing. There are a lot of zombie companies, deadwood in the system, if you will, that had quantitative easing not come along and forced back open the junk bond market that we wouldn't have with us today. So there's a lot to be said for working out a lot of the vestiges of the last cycle, even if, as we head into this one, it's just now we have to talk about it in much bigger numbers.
What about the biggest recipient, or one of the biggest, would be just the real estate sector in general? What has to happen with that?
Well, it's interesting because there are so many different facets to the current real estate cycle that haven't applied in the past, namely all the capital flight out of China and the impact that has had, in addition to the Fed being too low for too long. So we've really had real estate, especially high-end real estate, commercial real estate in this country, turbocharged, but we're starting to see that come off in advance of a Fed cutting cycle, which is kind of unprecedented. You normally consider real estate to be the caboose in terms of cyclicality and the last sector to fold. The fact that we're seeing real estate as weak as it is, and weakening quickly, especially in cities like Vancouver, is extremely intriguing for somebody like me who's been following cycles for generations now.
Okay, so where do you see us? They were talking about slowing down. I think Jim Grant wrote something. He thought they were actually going to cut Have we crossed the threshold here? Are we looking at a cut the next time?
Oh, look, the Fed has never, ever, not whether you're talking about whether a loosening campaign or a tightening campaign, if there's a 100% probability priced into markets, the Fed has never defied that. So it's moot at this point to debate whether or not it's going to be a cut or not. What markets have begun to price in, there's an over 33% probability priced into the market that there's going to be a 50 basis point cut in July. So right now, the only debate that's valid, I think, is whether it's going to be a quarter point or a half point cut on July the 31st, and whether or not at the same time they say we're pulling the plug earlier than anticipated. They planned for September, but we're going to pull the plug earlier than anticipated on quantitative tightening in contingency with the beginning of an easing cycle.
Now, they were talking about discontinuing that sort of, third quarter anyway. Would it be seen as panic if they did it early?
I don't think. I don't think that it would exhibit panic as much as it would exhibit rationale. You don't want to say we're going to have two conflicting policies working against one another and actually put your name on that. You wouldn't want to be easing and tightening at the same time, which is effectively what quantitative tightening and cutting interest rates would be. So I certainly wouldn't be surprised about that. There would be no hypocrisy in there for the Fed. It would be rational.
What are they talking about right now in those meetings, sort of behind the scenes? Is it the reversal in the stock market at the end of last year that really got them concerned? Are they talking about the president and what he's saying? Are they looking at the price of gold, which is at multi-year high now? What things are they talking about that would be interesting to us?
Well, they're not talking about gold, so we can put that behind us first and foremost. Are they talking about December? Absolutely. But they're talking about December more so than just in the context of what happened in the stock market. They're talking about what happened in the credit markets. And when you have junk bond issuance go away, vanish for 41 record days, that's going to get the attention of not just policymakers at the Federal Reserve, but policymakers worldwide, because we've got upwards of $250 trillion of debt. Stock market volatility it's children's play compared to credit market volatility. And that is really what frightened Jay Powell, because there are certain things that he simply does not have the tools to combat. And that would include credit market volatility becoming unhinged, because as we saw between November the 14th and 41 days that followed, if liquidity dries up, there's nobody that has the power to be able to address that. In the credit markets, they feed directly into the stock market via share buybacks. If you have a bunch of CFOs who are forced to pay attention to their balance sheets because we have a credit liquidity event in the markets, that's going to have the double whammy effect of, we've got 30 some odd % of the entire bond market to refinance in the next few years. That's not going to happen if there's no liquidity. And also, there would be a cease and desist on share buybacks, which would not be good for the stock market. So it would be a double whammy.
I'd like your opinion on what they're trying to do in terms of managing the business cycle. We've had an extremely long period of what they would call expansion. Everybody knows that we have to reverse that sooner or later. What is the end goal here? If they go toward cutting again, accommodative, are they trying to skip yet another recessionary period and extend it even further? Or are they just trying to ease us into a recession without triggering some type of horrible credit event or something similar to what we had in 2009?
Well, that's certainly the goal, is to engineer a soft landing. And the only problem with that is it would be the first. One of the few times that they were able in history to come out would have been 1995, when they came out with something of an insurance rate cut. There was a complete bloodbath at the time in the bond market, and they were able to buy a few more years of expansion in the stock market to where it got to record high valuations. But other than that, the last two times, and this is simply how history works, the last two times the United States has gone into recession, the Fed has come along too little, too late in terms of trying to ease policy, and we've ended up in recession. I'll remind you that it was September the 18th, 2007, that the Federal Reserve cut rates by 50 basis points, a half point, and again, that was too little, too late. The same exact thing happened in 2001. The yield curve inversion had already told policymakers, and as is the case today, the yield curve inversion, as Morgan Stanley modified it to allow for quantitative tightening and the additional tightening that was put into the system, the yield curve's been inverted since December. There's not much the Fed can do to get out in front of recession at this point, and we haven't even spoken, the two of us, about the fact that the real economy's already begun to slow. So the train's left the station.
Danielle, I'd like to get your take on how you interpret these manipulations of the yield curve. Are you of the old school, where it says this is signaling a recession, or do you believe that with the way governments are, I guess, participating in quantitative easing type activities, that you really can't interpret it the same way that people have in the past?
Well, I think what you need to do is what my good friend Ellen Zentner at Morgan Stanley has done, and that is adjust the yield curve to account for unconventional monetary policy, quantitative easing, quantitative tightening, and the amount of additional stimulus that was put into the system via QE, and then the amount of stimulus that has been taken out of the system via quantitative tightening. And once you do that, you actually see that the inversion occurred much earlier on in the cycle than we had thought, and therefore you're not just misreading the importance of the yield curve inversion, but you're late.
Okay.
Yes, to answer your question, the yield curve matters.
If we're late, would you say, if you sort of adjusted the way we looked at things in hindsight later, will we say we were in a recession right now?
You know, it's entirely conceivable. It's really hard to say. Things are moving at such a rapid pace at this time. We've got year-over-year activity in the 3 West Coast megaports down year-over-year. We've got rail activity coming down and coming down fast. We've got truck freight activity down 6 months year-over-year, down 6% to the lowest year-over-year rate since 2009. So we are a nation that consumes. It is reflected in what we order online and what is transported across the country and comes into our ports. And if you look back at the 2000 episode of when the yield curve inverted, which was in an environment of extreme overvaluation in risky assets, this was the NASDAQ bubble. In that instance, we only had 12 months from the point of inversion to when we were in recession. But the only thing that's different this time, to parrot others, is we don't just have a NASDAQ bubble. We have a bubble across the full spectrum of risky assets. And that tells you that the sensitivity of the economy and the yield curve inversion as a signaling mechanism may even be less than that 12 months that we had between 2000 and 2001 when we landed in recession. In other words, to answer your question, we could be by the third quarter. Okay.
Finally, about the soft landing, I know you're skeptical. I'm curious to know what they consider a soft landing. What would be a success if they were able to avoid disaster? Would it be, I don't know, 10, 20% correction in the stock market, that's it? More? What does that mean in terms of unemployment? What do they consider success in a soft landing?
I think that they would consider success to basically adhere to what their forecast is. And they're still calling for the unemployment rate to be south of 4% here going out a few years, which means that they fully anticipate that their moves are going to be able to prevent the labor market from becoming infected by whatever is going on. And that would only be reflected in them being able to prop up the stock market throughout a potential slowdown, such that they didn't even have to go to the zero bound. I think it's right up there with unicorns.
It sounds like fantasy, Danielle. What about the effect on global markets? They're tinkering with the dollar. That always has effects. Do they consider those in those meetings?
Well, they say they don't, which means they do. And we are make no doubt, we are in a full, if the Reserve Bank of Australia, for heaven's sakes, is talking about unconventional monetary policy, they're the most disciplined monetary policymakers, central bankers on planet Earth. They never went to the zero bound. But if you've got the Bank of Japan, the European Central Bank, the Fed all talking about effectively competitive rate cuts. I'm not sure where Mario Draghi thinks he exactly is going to go, since he's starting in negative territory. But if you're to the point where you're all talking about rate cuts and easing at the same time, that is not a theoretical, it is a de facto currency war.
When these different central banks, they've all engaged in some sort of inflationary manipulation, but when they look at the policies that each of them have adopted, so maybe like we would be looking at negative interest rates and sort of the equity purchases they're doing in Japan, what do you think they've concluded has worked and what has not worked?
Well, that's an interesting question, because I'm not quite sure what they could conclude at this point has worked, aside from inflating real estate, propping up risky asset markets. I mean, there was a Japanese corporate bond, that priced with a negative yield. These are very difficult discussions for me to have, because I don't think that these policymakers have accomplished squat. That's a technical term. But would they ever admit to it? No. I mean, recently Mario Draghi was asked if the negative interest rate policy had been detrimental to the financial system, and he said that they were looking into the issue. I mean, look at the bank stock index in Japan, look at the bank stock index in the European Union, and the only saving grace here for the United States from sliding into negative interest rates is that Jamie Dimon and other great big bankers have a lot of money to lobby Congress and make sure we don't slide into negative interest rates in the United States, because it would slam our banking system.
I mean, one thing that has, I guess, turned out well for them is that it's bought them time, if that's worth anything, right? Draghi coming out and saying whatever it takes, or I can't remember his exact words, but they were in bad shape at that point, and it did buy them time. What we don't think is it has
bought them the sanctity of the euro. So they maintained the euro, and they've managed to keep Italy from falling off the planet. So right. Yes, congratulations.
Okay. Any idea what your old boss, Mr. Fisher, is thinking about what's going on here?
You know, I think that he has always been of the opinion that if you try and keep the patient on the drug for too long, you're going to have a detrimental effect. You're going to end up with an addict on your hands. It's very clear that because the ECB and the Bank of Japan are discussing cutting policy and easing with negative interest rates, that is where we are. You literally cannot unplug the patient, and I think that Richard would be right there.
Okay, before I let you go, Danielle, I want to talk about the conference you're going to be headlining. It's July 30th to August 2nd. You're basically going to be coming directly from the Fed meeting, yes. Covering that announcement to our conference, which is just delightful. I'm already getting people emailing me saying excited about it and saying, oh, you got to ask her, these questions about the meeting. What are you going to be talking about besides that? Or maybe that'll be all we talk about, depending on what's going on.
Well, I think that at that point, we will have seen the rate cut. We'll know what the fate of quantitative tightening is, and we'll know how many bullets left in the chamber we have. And more importantly, we'll know a lot more about how the real economy has evolved. I suspect that the actual subject of the day will be what the Fed will be able to do, capable of doing in terms of combating recession. And I don't know that there will be any answers, but I think that there will be a lot of contingency planning that we can discuss there at the conference in terms of what the options are.
I can't wait, Danielle. So details at sprottconference.com, or go to the bottom of this video for the link. Use the discount code FEDUP, and we will give you a free copy of Danielle's book, which she'll be happy to autograph for you at the conference. So that's discount code FEDUP. Danielle, thanks for coming back on the channel. I really appreciate it, and I'd love to do this again with you soon. Folks, you can follow her on Twitter at DiMartino Booth. Thanks very much, Danielle.
Thank you.